China just made a move in its gold market, and almost nobody outside the trading world has noticed it yet. On the surface, it looks boring. A few banks tightened some paperwork. Margin requirements went up. That's it, right? Except it isn't. Once you actually dig into what changed, who it affects, and why now, you start to see something bigger. This is about who gets to trade gold, how much leverage they're allowed to use while doing it, and ultimately how the price of gold itself gets decided. So stick with me for the next 35 minutes or so, because I want to walk through this properly instead of giving you the 30-second headline version that half the internet is running with right now. I've seen at least a dozen videos already botching this story. Some are saying China is banning gold. That's not what's happening, and if you take one thing away from everything that follows, let it be that distinction, because it changes how you should read the rest of this entirely. Here's the plain version. Several of China's largest banks are pulling back retail access to certain gold trading products. We're talking about the Industrial and Commercial Bank of China, Postal Savings Bank of China, Ping An Bank, and China Guangfa Bank. These institutions have spent years acting as the middlemen that let regular people trade gold products linked to the Shanghai Gold Exchange without ever touching a bar of the stuff. Nobody is stopping you from buying physical gold in China. You can still walk into a shop and buy coins or bars. What's getting restricted is retail access to paper gold, meaning contracts and leveraged instruments that track the price of gold without any metal changing hands. Think about what that actually means in practice. A regular investor puts down a relatively small amount of money and controls a position worth many times that. Gold moves 2% in a day, which happens more than people think, and suddenly that investor's account has swung by 10 or 20% depending on how leveraged they were. Some of these products let you get in with margin requirements that used to sit far lower than what's now being demanded. And that's the actual lever China just pulled. In some cases, banks are pushing margin requirements up toward 140%. Read that number again. That's not a small tweak. That's a wall. At that level, the math on leveraged retail gold trading basically stops working for most ordinary investors. You'd need to put up more collateral than the position is even worth in some structures, which tells you the intent here isn't subtle at all, even if the announcement was. I want to slow down here because this distinction is the whole ballgame, and most coverage glosses right over it. Physical gold is exactly what it sounds like. Bars, coins, jewelry you can melt down if you're desperate enough. It sits in a vault or a safe or under someone's floorboard, and its supply is limited by how much comes out of the ground and how much gets recycled. Nobody can print more of it. Paper gold is a different animal entirely. These are financial contracts, futures, certain leveraged retail products, and other derivatives that are priced off the gold market without any obligation for anyone to actually deliver metal. You're betting on where the price goes. The counterparty on the other side is doing the same thing. No gold moves, no vault gets opened. Here's the part that should genuinely bother you if you didn't already know it. The total value of paper claims on gold, worldwide, dwarfs the actual physical gold sitting in vaults that backs any of it. Estimates on exactly how many multiples vary, and I won't pretend I can give you an exact number, because honestly, nobody can. The market isn't that transparent. But the ratio is large. Some analysts have floated numbers like 100 paper ounces trading for every 1 physical ounce that could plausibly back it in a squeeze. Whether it's that extreme or more conservative, the direction of the problem is the same. Paper trading volume, not physical buying and selling, is what moves the price most of the time. That's a strange thing when you sit with it. The price of a physical, tangible asset, one that's been used as money for thousands of years, is set day to day mostly by people who never intend to take delivery of any of it. It's a bit like the tail wagging the dog, except the tail is enormous, leveraged, and prone to panic. So when China restricts retail access to leveraged paper gold specifically, and leaves physical ownership completely untouched, they're drawing a line right down the middle of that whole system. They're saying, in effect, we're fine with you owning the metal. We're less fine with you using borrowed money to bet on its price swings in a way that can spiral out and force liquidations across the system. None of this happened in a vacuum, and I think it's worth backing up for a minute because China's relationship with gold has actually shifted a lot over the past 25 years or so. For most of the 20th century, private gold ownership in China was heavily restricted. The government controlled it tightly, partly for currency stability reasons and partly out of old capital control habits that go back decades. That started changing in the early 2000s when Chinese authorities began gradually liberalizing the domestic gold market. The Shanghai Gold Exchange opened its doors in 2002, giving China its own centralized, physically backed venue for gold trading for the first time since the market had been effectively closed to individuals for generations. From there, it snowballed. Retail investors got access to gold accounts through commercial banks. Gold panda coins and other physical products became widely available and genuinely popular, not just as jewelry, but as a savings vehicle for households who'd grown up distrusting paper assets after watching currencies get devalued within living memory. China became, and still is, one of the largest gold consumers on the planet, both through central bank purchases and plain household demand. Somewhere along the way, banks started layering leveraged paper products on top of that physical foundation, giving retail investors a way to speculate on gold prices without buying actual metal. That's the part that grew fastest, and arguably grew a little recklessly, particularly as more speculative capital flowed into these products during periods like the recent rally. What we're watching now looks a lot like regulators trying to walk back specifically the part of that expansion that got the least disciplined, while leaving the much older, much more culturally embedded physical ownership tradition completely alone. Let's get into the mechanics for a second, because raising margin requirements sounds dry until you actually trace through what it does to a trading system under stress. When margin requirements are low, a small move against your position can wipe out your collateral fast. The broker or bank then issues a margin call, and if you can't or don't top up quickly, your position gets force liquidated. That selling adds to whatever price move triggered it in the first place. If enough people are leveraged the same direction at the same time, you get a cascade. One person's forced sale drops the price a bit further, which triggers the next person's margin call, and so on down the line. This is exactly the mechanism behind a lot of the sharpest, ugliest moves in any leveraged market, not just gold. It's the same dynamic behind crypto liquidation cascades, and it shows up in equity markets during margin-driven sell-offs too. Gold is not special in this regard. It's just usually thought of as the safe asset, so people forget it can behave exactly like every other over-leveraged market when things get crowded. By pushing margin requirements up to something like 140%, Chinese banks are essentially removing the fuel for that cascade at the retail level. Fewer people can get dangerously leveraged in the first place, which means fewer forced liquidations down the road, which in theory means less of that self-reinforcing panic selling that makes a correction worse than it needed to be. Is that a good thing for individual traders who liked having access to that leverage? Depends who you ask. If you were making money on it, you're probably annoyed. If you got wiped out during the recent reversal, you might actually think this is overdue. Now let's talk about why this is happening right now, because timing tells you almost as much as the policy itself. Earlier this year, gold went on an absolute tear. Prices pushed up toward the $5,500 an ounce mark at the peak, which is a staggering number if you rewind even a few years. And remember, gold spent a long stretch of the 2010s trading in the $1,200 to $1,400 range. The rally didn't come out of nowhere. You had persistent inflation worries that never fully went away. You had geopolitical tension simmering in multiple regions at once. And you had a wave of speculative money piling into gold as the trade of the moment, the way money piles into whatever's working until it suddenly stops working. Then it reversed. Hard. Gold fell back below the $4,000 level, and depending on exactly where you mark the peak and the trough, that's one of the steeper pullbacks gold has seen in recent memory. Not a slow drift down, A real reversal, the kind that leaves a mark on people's portfolios and on their nerves. Three things drove that reversal, and I think it's worth separating them out instead of lumping them together the way a lot of coverage does. First, interest rate expectations shifted. When rates are expected to rise, or even just stay higher for longer than the market had priced in, gold gets less attractive relative to yield-bearing assets. Gold doesn't pay you interest, it never has. So when bonds and cash start paying more, some of that speculative money that piled into gold during the rally has an incentive to rotate back out. Second, the dollar strengthened. Gold is priced in dollars globally, so a stronger dollar mechanically makes gold more expensive for everyone holding other currencies, which tends to dampen demand. It's not the only factor, but it's a real and consistent one across basically every gold cycle you can look back on. Third, and this is the one I think actually matters most for our story today, there was a serious unwind of leveraged retail positioning. A lot of the money that rode gold up to $5,500 wasn't patient, long-term buy and hold money. It was speculative, leveraged, momentum-chasing money. And that kind of money is quick to run for the exit the moment the trend even hesitates, let alone reverses. When it runs leveraged, which means the exit gets amplified through exactly the liquidation cascade mechanism I just walked through. So you get this ugly feedback loop. Price starts falling for fundamental reasons like rates and the dollar. Leveraged longs start getting margin calls. Forced selling kicks in. That selling pushes the price down further than fundamentals alone would justify. More margin calls follow. Rinse and repeat until the leverage in the system gets flushed out. There's a detail in that unwind worth sitting with for a second. When leveraged retail money floods into an asset during a rally, it doesn't just add buying pressure on the way up, it also builds a kind of hidden fragility into the market that nobody notices until price starts moving the other way. Every leveraged long position sitting out there is, in effect, a future forced seller waiting for the wrong 5% move to show up. Nobody rings a bell to warn you how much of that fragility has built up. You only find out in hindsight once the reversal has already happened and everyone's trying to explain why it was so much sharper than the fundamentals alone would suggest. If you're a regulator watching that unfold, and especially if you're the kind of regulator who thinks in decades rather than quarters, the leveraged retail piece is the part you actually have some control over. You can't control global interest rate expectations. You can't control the dollar. But you absolutely can control how much leverage your domestic retail investors are allowed to take on when trading a specific product through specific institutions. That's precisely what this move targets. The official line from Chinese regulators is about investor protection, reducing excessive leverage and stabilizing behavior during volatile conditions. And I don't think that's a lie exactly. It's a real concern, and plenty of retail investors genuinely did get hurt in the recent reversal, especially the ones trading leveraged products who didn't fully understand how fast those margin calls can hit. But I'd be doing you a disservice if I stopped at investor protection and called it a day, because I don't think that's the whole story, and I don't think Chinese regulators think it's the whole story either. Here's where it gets more interesting than a simple consumer protection story. What China is doing, whether it's fully intentional or partly a byproduct of managing risk, is drawing a much cleaner line between physical gold ownership and speculative paper exposure. And once you tighten retail access to the paper side specifically, you shift the balance of what's actually driving price discovery in the market. Right now, across global gold markets generally, paper trading volume absolutely dwarfs physical buying and selling on a day-to-day basis. Futures contracts on exchanges like COMEX trade in volumes that represent far more gold on paper than physically exists to back them if everyone tried to take delivery at once. Nobody actually tries that, which is exactly why the system works most of the time. But it does mean that short-term price swings are often driven by speculative positioning, momentum trading, and leverage unwinding rather than by someone in Shanghai or Mumbai or Zurich deciding they want to buy an actual bar of gold. By tightening retail leverage specifically, China is nudging its own domestic market's price discovery a little further toward physical demand and a little further away from short-term speculative churn. It's a small nudge in the grand scheme of a global market. Sure, China isn't single-handedly rewriting how gold trades everywhere, but it's a deliberate nudge, and it fits a pattern I think is worth zooming out to look at. I'd also push back gently on anyone framing this purely as China cracking down on its own people. Every major financial regulator eventually runs into this same tension between letting markets do what markets do and stepping in when leverage gets so widespread that a correction stops being a correction and starts being a systemic event. The Chinese banking system isn't unique in facing that trade-off. It's just the one making headlines about it this particular month. Because here's the thing, this isn't happening in isolation. Step back and look at the last several years globally, and you'll notice central banks around the world have been accumulating physical gold reserves at a pace that's genuinely unusual compared to the prior few decades. Countries have been adding to reserves for a mix of reasons. Diversification away from any single currency. Hedging against sanctions risk after seeing how quickly reserve assets can get frozen, and general skepticism about holding too much of any single government's paper promises. At the exact same time, retail investors in most Western markets have been pushed in the opposite direction, toward gold ETFs, futures, and other paper instruments rather than physical ownership. It's more convenient. No storage costs, no worrying about a safe, easy-to-trade on your phone, but it means most individual investors' gold exposure is really just a claim on a fund that itself may or may not hold the exact amount of physical metal you'd assume. China's retail crackdown fits neatly on the physical side of that global split. While everyday Western investors are being nudged toward paper gold products for convenience, Chinese regulators are nudging their own retail base in the opposite direction. Less leveraged paper speculation, continued encouragement of physical ownership through vaults, bars, and coins. I don't think that's a coincidence, and I don't think it's purely about consumer protection. I think it reflects a broader strategic preference within Chinese policy circles for physical metal over paper claims, which lines up with everything else we've seen from Chinese gold policy over the past decade. It's worth a quick detour to compare because China isn't inventing the idea of restricting retail leverage out of thin air. Regulators elsewhere have wrestled with almost the exact same problem, just applied to different asset classes. Retail foreign exchange trading is probably the closest parallel. In the United States, regulators capped retail forex leverage years ago after watching how badly undercapitalized retail traders got hurt trading currency pairs at 50-to-1 or even higher leverage ratios. European regulators went even further in the late 2010s, restricting leverage on contracts for difference products, including gold CFDs, specifically because retail losses on these leveraged instruments were embarrassingly common. Something like 3 out of 4 retail accounts trading CFDs were losing money under the old leverage rules in some regulatory studies, which is a genuinely brutal statistic when you sit with it. So in that light, what China's banks are doing isn't some radical, unprecedented intervention. It's catching up to a pattern regulators in other major markets already went through with different leveraged retail products. The novelty here isn't restricting leverage, it's specifically doing it for gold, an asset most people don't think of as needing that kind of guardrail because it carries this old reputation as the boring, safe, grandma's jewelry box asset. Turns out even the safe asset gets dangerous once you strap enough borrowed money to it. There's another layer to this that doesn't get nearly enough attention, and it involves Shanghai and Hong Kong's growing role in gold clearing and settlement. For most of the modern era, gold pricing and settlement have run through Western financial centers, primarily London and to a lesser extent New York. The London Bullion Market Association's benchmark pricing has functioned as a kind of global reference point for decades, and COMEX futures out of New York are the dominant paper trading venue globally. China has spent years building out alternatives. The Shanghai Gold Exchange offers physically backed contracts with actual delivery mechanisms, which is a meaningfully different structure from a lot of Western paper trading. There's been ongoing discussion and infrastructure development around expanding gold clearing and settlement capacity through both Shanghai and Hong Kong, positioning them as parallel hubs alongside, not necessarily replacing, London and New York. If that trajectory keeps building, and I want to stress this is a if, not a certainty, you could eventually end up with a more genuinely multipolar gold pricing system. One that isn't quite as dependent on a couple of Western institutions setting the tone for the entire world's gold price. That would be a meaningful shift in market structure, even if it happens slowly and unevenly over years rather than announcing itself with some dramatic headline moment. I know the term de-dollarization gets thrown around a lot, sometimes by people who are trying to sell you something, whether that's a newsletter subscription or a pile of coins at a markup. So let me be careful and precise here instead of getting dramatic about it. China has spent years working on infrastructure that reduces its dependency on Western-controlled financial rails. That includes alternative payment settlement systems, expanded bilateral trade agreements that bypass dollar invoicing where possible, and yes, building out gold infrastructure that could eventually operate somewhat independently of London and New York pricing mechanisms. None of this means the dollar's role as the dominant global reserve currency is about to collapse next quarter, or even next decade probably. That's a much bigger, slower, more structurally entrenched thing than any single policy change. Reserve currency status is sticky. It's built on decades of deep liquid bond markets, legal predictability, and plain old habit. And none of those things change because a few banks in Shanghai raised margin requirements on retail gold contracts. But this retail gold crackdown fits as one small piece of a much larger, longer-running project of building parallel financial infrastructure. It's not the headline event in that story. It's a footnote. But footnotes add up over enough years, and I think this is worth filing under that broader trend rather than treating as some standalone consumer protection measure and nothing more. Okay, let's bring this back down to something practical, because I don't want to leave you with just theory and geopolitics. If you're an ordinary investor in China or anywhere else, and you own physical gold or a straightforward unleveraged gold ETF, this news doesn't really change your situation. Nobody's coming for that. The restriction is specifically on leveraged retail derivatives trading through certain Chinese banking intermediaries. If you were trading leveraged gold products, especially through the specific institutions named here, your access is about to get a lot harder or a lot more expensive to maintain. That's worth knowing if you've got exposure there. More broadly, I'd take this as one more data point suggesting that gold, at least at the policy level in China, is increasingly being treated the way central banks already treat it, as a long-term strategic reserve asset, not a short-term trading vehicle. If you're someone who holds gold as a hedge, as insurance against currency debasement or geopolitical shocks, this doesn't threaten that thesis at all. If anything, it slightly reinforces it because it suggests one of the world's largest gold-consuming nations is actively trying to reduce the speculative noise sitting on top of a market. It clearly wants people treating with a bit more seriousness. If you're someone who is using gold as a short-term leveraged trading vehicle, well, that's a different conversation, and I'd gently suggest that's always been a riskier game than most people trading it fully appreciated, regardless of what China does with its retail margin requirements. Leverage doesn't care whether the underlying asset is gold, oil, or a meme stock. It amplifies whatever happens in both directions, and the direction it amplifies is not something you get to choose in advance. One more practical note before I move on. If you're outside China and none of these specific banks or products even apply to you, don't let that make you tune out entirely. Regulatory patterns like this tend to travel. When a major economy tightens leverage rules on a specific asset class, other regulators watch closely. And sometimes similar rules show up elsewhere a year or two later once the data on retail losses becomes hard to ignore. I'm not saying it's guaranteed to happen in your market too. I'm saying it wouldn't shock me, and it's worth keeping half an eye on if you trade leveraged gold products anywhere. I'll be straight with you. I don't think this is some grand, fully coordinated master plan where every regulator in Beijing sat in a room and mapped out a 10-year strategy to dethrone the dollar through gold policy. Real policymaking rarely works that cleanly in any country. I think this is regulators responding to a genuinely messy, leveraged retail blowup, while it also happens to line up conveniently with longer-running strategic preferences that were already there in the background. Both things can be true at once. It can be a legitimate risk management response to a bad few months of leveraged retail losses, and it can also nudge the country's gold market a little further in a direction Chinese policymakers already wanted to go anyway. I don't think you need a conspiracy to explain that. Sometimes the boring explanation and the strategic explanation just happen to point the same way. Where does it go from here? I'd expect other Chinese banks to follow with similar restrictions if they haven't already by the time you're watching this, since regulators in China have a well-documented habit of rolling out policy changes at a handful of institutions first and letting the rest fall in line shortly after. I'd expect continued central bank gold accumulation globally to keep running in the background regardless of retail trading rules, because that trend has its own momentum tied to reserve diversification that has nothing to do with any one country's retail policy. And I'd expect the slow build-out of Shanghai and Hong Kong as settlement hubs to keep progressing quietly without a single dramatic announcement that makes headlines the way a margin hike apparently did. I'll also say this. If gold does keep behaving more like a strategic reserve asset and less like a retail trading chip, that probably means fewer of the wild, leverage-driven swings we've gotten used to seeing, and more of the slower, grinding moves that come from central banks and institutions accumulating steadily over years. That's a less exciting story to trade, honestly, but it might be a healthier one for the market as a whole. None of this is a supply shock story. It's not a gold is about to run out story. It's a story about who gets to speculate, how much borrowed money they're allowed to use doing it, and where in the world the eventual price of gold actually gets decided. Slower moving, less flashy than the headlines suggest, but honestly more important if you're thinking years out instead of days out. That's the real story behind the headline, stripped of the China bans gold panic that a lot of channels are running with right now. If this kind of breakdown is useful to you, let me know in the comments, and if there's appetite for it, I'll put together a longer, more detailed piece on my Substack and Patreon, digging into the Shanghai Gold Exchange delivery mechanics specifically, since that's a whole rabbit hole on its own, and honestly deserves more than a few minutes at the end of a video like this. Thanks for sticking with me through this one. I'll see you in the next video.